Hi guys, let's start in about 5 minutes. Guys, just let's start in about 5 minutes. Yeah. Guys, online, you can all hear me, right? Okay. Just give me a confirmation, please, if you can hear me. I'm just setting up the class. Just give me 5 minutes. All right. Good evening, students, and thank you for being here today. Just to confirm, all right, you can hear me. Super. Right. I'm just going to take the question and put it across on screen so that we can start working through. Lovely. As always, I am going to go to Kaplan. Okay, we've actually practiced quite a few questions, haven't we? So we've practiced quite a few questions, and I know that you've been looking at questions, but today let's look at a detailed question for FR, right? Probably something like this can definitely come in the exam. So let's try to understand how to work around a question like this, right? So onto your screen, I've got Fresco. Fresco is not a challenging question, but then again, it has a lot of details that would definitely help us with the exam preparation. So the session is to make sure that we practice more questions before the exams, like advised earlier. Everybody with me? Everybody, are you with me? Just give me a done. Everybody, yes, give me an A at least so that I know you are with me. Everybody, I want everybody to give me a yes or an A. All right, there are some students coming from my end. Right. Super. All of you can hear me, all of you can see me, and we are good to go. Right. As always, we've got a requirement, but this time we've got a statement of changes in equity as well. So prepare the statement of profit or loss for Fresco for the year ended 31st March 2012. Prepare the statement of changes in equity for Fresco for the year ended 31st March 2012. And prepare the statement of financial position of Fresco as an and statement of financial position. Not new, we know it, we've done it. But this time, all together, so we are going to see how to also incorporate statement of changes in equity. Before you get going. Guys, if you're done, just give me a done. If you're done reading the question, give me a done, please. All right, time up. Can we start? Right, let's start. Well, let's go to the question. The question says, the following cal balance relates to Fresco at 31st March 2012. Okay, fine, that's good. But you have equity shares of 50 cents each, share premium, retained earnings, leased property, plant and equipment at cost, accumulated amortization. All right, time up. Oh, let's start. Give me a moment. Right, let's start. I think I've... Well, let's go to the question. The question says, the following cal balance relates to Fresco. Parallel switched on. Okay. Right, there you go. Super. So we've got plant and equipment at cost, accumulated amortization of leased property, accumulated depreciation of plant and equipment, inventory, trade receivables, bank, deferred tax, trade payables, revenue, cost of sales, lease payments, distribution cost, admin expenses, bank interest, current tax, and suspense account. Okay. Are we clear? Are we clear? Everybody, are we clear? Everybody keep responding. I'm waiting for you. Keep responding. Right. The suspense account. There you go. Here you've got suspense account. The suspense account represents the corresponding credit for cash received for a fully subscribed rights issue of equity shares made on 1st of January 2012. The terms of the share issue were 1 new share for every 5 held at a price of 75 cents each. Okay, like always, what you do in the exam is you leave about 50 lines, you come right to the bottom, come here, you come here, and you say workings. Always workings. And then you do your workings based on the notes. You do your workings based on the notes. So you go through the notes once and you do your workings, and based on your workings, you work your answers out. Sounds like a plan? Brilliant. The suspense account represents the corresponding credit for cash received for a fully subscribed rights issue of equity shares made on 1st of January 2012. The terms of the share issues were one new share for every 5 held at a price of 75 cents each. Okay, your examination is here. Look here, there is suspense account, which represents 13,500. They say this is for a share issue, but a rights issue. So technically, your rights issue has not been accounted well. So if you've gone for a rights issue, you will debit cash and credit your share capital. They say your debit entry is okay, no problem. But your credit entry, there's a problem. So what you've got to do is you have to adjust the credit entry. Are we clear? Are we clear? Are we clear? Okay. Now think through and somebody respond as to how to work around this. Somebody give me a response and let's do it together. First, give me your answers. Start responding. What do you think? What has happened? Your debit entry is given properly, but your credit entry, there's a problem. So technically what you need to do is, okay, your suspense account represents a corresponding credit entry. Okay, so what is the terms of the rights issue? The rights issue were made at one new share for every 5 held. Okay, if you have 5, I'm going to give you 1. So how many shares does the company have? How many shares does the company have? How many shares? 45,000 is the value of the share. So 45,000 divided by 2. Sorry, 45,000 into 2. So equals 90,000 shares you had. So 90,000 shares that you had, you have a value of 50 cents per share. So that is 45,000. That's how you get it. So this 90,000 shares, with this, you're going for a rights issue. Correct? So your rights issue percentage is 1 for 5. So 90,000 into 1 for 5. And you're issuing the rights at 75 cents. So equals 90,000 over 5. 18,000 shares at 0.75 would be 13,500. That's right. But now the problem is accounting it. No. How to account? Listen to me very carefully. How to account? There will be a portion that will go to share capital. There will be a portion that will go to share premium. Correct? How much will be your share capital figure? How much will be your share premium figure? How much will be your share capital figure? How much will be your share premium figure? Equals 18,000 into 50 cents is the share nominal value. 9,000 will go to your share capital equals 18,000 into your premium is 0.25 will go to share premium. Is that clear, everybody? Do you get it? Do you understand it? Is or no? Do you understand it, everyone? Is it okay? You understood that, right? Clear, right? Okay, super. So that's the first problem. So we've answered the first problem. We've got the first problem solved. In every exam session for FR, you're going to get an IA 16 adjustment. You will get it. There's no two words about it. You will get it. Now here they say, to reflect a marked increase in property prices, Fresco decided to revalue its leased property on 1st of April 2011. So you have leased property, you're going to revalue it. The directors accepted the report of an independent surveyor, valuer, who valued the lease property at 36 million on that date. Okay. Now working one, rights issue, done. Nothing to worry. Working two, revaluation. Okay, what's happening? You are revaluing your leased property. So we come down, leased property revaluation. So two things. You have your fair value. They say the leased property fair value is 36 million, 36,000. And Fresco has not recorded the revaluation, the remaining life. Before coming there, first, let's take it one by one. This sentence, let's finish it off. Your fair value is 36,000. You require your net book value to understand the, to understand what? To understand the revaluation. Now, how much is your net book value? Everybody, how much is your net book value? Lease property, how much is your net book value? How much is the net book value? Everybody start responding. How much is the net book value? I want everybody to respond. I want everybody to respond. Net book value will be your lease property cost 48,000, amortization 16,000. So your net book value will be equals 48,000 minus 16,000 gives you 32,000. Therefore, your revaluation gain will be this minus this. Do you understand, everybody? Yes or no? Guys, do you understand? Yes or no? Everybody, do you understand? Super. So now that is done. Let's go further. Your revaluation is going to be fair value 36,000, which is given here. And then your net book value is going to be your cost, which is 48,000 minus your amortization 16,000. So that gives you 32,000. So 48 minus 16, 48 minus 16, which is 32,000, which is 32,000. Guys, do you understand? Guys, do you understand? That's done. The remaining life of the leased property is 8 years at the date of revaluation. Now, what is that? The remaining life is 8 years. Now, you've done the revaluation. Next working, depreciation. They say depreciation for the leased property is going to be 8 years. So, remaining life is 8 years, meaning your depreciation will be equals 36,000 divided by 8, 4,500. Understood? Understood? Do you understand? Yes or no? Everybody, please respond. Please respond. Do you understand? Do you understand? Depreciation is 4,500. Give me a yes, everybody. Okay. Done. Fresco makes an annual transfer to retained profits to reflect the realization of revaluation surplus. In Fresco's tax jurisdiction, the revaluation does not give rise to a deferred tax liability. Now, what they say is, listen to me very carefully, this is not a very regular adjustment. Sometimes you might get it. Now, what are they saying? Because you revalued, there is additional depreciation. Are we clear? Because you revalued, there is additional depreciation. They say this additional depreciation, okay, listen very carefully, this additional depreciation is transferred to the revaluation reserve. That can be done, not a problem. IA 16 permits that. IA 16 says if there is additional depreciation after revaluation, you have revaluation, and because of revaluation, there is additional depreciation, means you can transfer it against, the revaluation surplus itself. So now we need to understand how much is the additional depreciation. Okay, let me repeat. Now you are revaluing, okay, from probably, okay, your value was 32,000 earlier, now it's 36,000, correct? There is additional increase in the value of the property, correct? The leased property's price is going up, yes or no? Yes or no? Now, because the value is going up, do you see that there is additional depreciation? Now, technically, it should have been, your depreciation should have been equals 32,000 over 8, 4,000. But it is 4,500, correct? It is 4,500, correct? Gone up by 500. Because it has gone up by 500, this additional depreciation of 500 can be set off against the revaluation reserve itself. So this additional depreciation, 500, can be set off against the revaluation itself. Meaning, you remove it from retained earnings and set it off against revaluation. Are we clear? Are we clear? Okay. Take a minute, everybody, read that adjustment again. Read that adjustment again. Read that adjustment, read that point again and adjustment. And you understand, everybody? You understand the adjustment? Because IA 16 says, if you revalue, it can result in additional depreciation. If it results in additional depreciation, probably revaluation gain is taken to other comprehensive income, and this depreciation will affect profits. So technically, it's not fair. To make it more fairer, this can be set off against the revaluation itself. Understood? Set off against, is it always doing in the exam? No, you will only do it if your examiner mentions this point. Fresco makes an annual transfer to retained profits to reflect the realization of revaluation surplus. You will only do if your examiner wants you to do. If not, you're not going to do it. Does that make sense? I'll show you how to do it, guys. Don't worry. I'll show you how to do it. Okay? Super. Now, here. On 1st of April 2011, Fresco acquired an item of plant under a lease agreement that had an implicit finance cost of 10% per annum. The lease payments in the trial balance represents an initial deposit of 2 million paid on 1st of April 2011. Okay. And the first annual rental of 6 million paid on 31st March 2012. Okay. First thing that you need to understand is, are we paying in advance or in arrears? Are we paying in advance or in arrears? The payments are being made in advance or in arrears? Everybody? You acquired on 1st of April 2011, and the first annual rental was paid in 31st March 2012. So you are paying in arrears. Am I right? You're not paying in advance. Okay? Are we clear? Are we clear? You're not paying in advance, you're paying in arrears, correct? Super. So the moment you see a lease adjustment, working number 3, lease. Very simply, I want you to put up few steps, easy steps, not difficult steps. I want you to put up some easy steps. Now, what is the first step? You are going to put up the fair value of the asset. What is the fair value of the asset? What's the fair value of the asset? The lease agreement requires further annual payments of 6 million on 31st March each year for the next 4 years. The present value of the lease payments, excluding the initial deposit, was 23,000. So 23,000 plus 2,000. The total value of the asset is 25,000. So fair value is 25,000. 25 million. And then minimum lease payments. Okay, what is the minimum lease payments? How much are you paying every year? You're going to pay, okay, 6,000 into, for how many years are you going to pay? For how many years are you going to pay? For 5 years. 1 year gone for the next 4 years. So into 5, 30,000. Therefore, your total interest that you're going to pay will be 5,000. Correct? Your total interest is going to be 5,000. Your finance cost, they say, your finance cost, they say, will be 10%. So simply you take these figures, right? Once you take these figures, not 4 years, it's 5 years, because 1 year, this year, in total, 5 years, 4 more years to go. In simple, you take that. And what I want you to do is, I want you to put up a little T account. I want you to put up a little T account. You can call it your lease payable account. So here what you're going to do is, you're going to take your brought forward. You have your brought forward lease payable, right? 2,000 already paid, so you have to pay 23,000, correct? Fine. It's in arrears, so you have finance cost, right, which has to be accounted for. So you have your interest. Interest is going to be 10%, don't forget, equals this into this gives you 2,300. Every year, you're going to make a cash payment. Every year, you're going to make a cash payment of 6,000. Therefore, 25,300, 25,300. You have carried forward of this minus this 19,300. First year, did you understand everybody? First year, did you understand everybody? Now, one thing you need to keep in mind is, you acquired on 1st of April and your year end is 31st March. April 2001 to 31st March 2002. Just 1 year gone. So out of your lease, 1 year gone. So when you're putting your T account, you have to do until the second year. If 3 years are gone, you have to do it until fourth year. If 2 years are gone, you will have to do until third year. The 2 million is a refundable deposit. Don't worry. That is already paid now. So you don't have to worry about that. So you have brought forward 19,300. Your interest copy paste is going to be this. For the second year, 1,930. You're going to pay cash of 6,000. Your carried forward will be 21,230 equals 21,230. This minus this 15,230. Now, if the lease period is 6 years, okay, the lease period is 6 years and 3 years have gone, you will go until fourth year. Now, the lease period was 5 years, 1 year gone, so I'm going until the second year. Understood? That's how it has to be. Okay. Now, I'm here. Now, I need to get few things for my calculation. I need the current liability, the non-current liability. I need the current liability, non-current liability, the net book value, the finance cost in the exam. These are the things that I require. My non-current liability will always be this if it is in arrears. 15,230, always that. My current liability will always be this minus interest in suspense. Always, always, always if it is in arrears. My net book value of the asset, I know the value of the asset is 25,000. Okay. I need to calculate depreciation. My lease is going to be for 5 years. So 2 years gone. 2 years gone. Correct? Sorry, not 2 years gone. 1 year gone. 1 year gone. So 25,000, 1 year gone. So equals 25,000. My depreciation is going to be equals 25,000 over 5. So 1 year gone means my net book value will be 25,000 minus 5,000, which is 20,000. And my finance cost relevant will be in the current year, only 1 year gone, 2,300. Everybody there, did you understand this? Yes or no? Everybody, did you understand this? Yes or no? I want everybody to respond. Super. So there you go. That's also done. Plant and equipment other than the leased plant is depreciated at 20% per annum using the reducing balance method. So there you go. Working number 4. Depreciation for other plant. Now, plant and equipment depreciation is at 20% per annum using the reducing balance method, other than the leased plant. Now, let's go back to plant and equipment. Cost is going to be 47,500, correct? Cost is going to be 47,500. Accumulated depreciation will be 33,500. Therefore, this minus this 14,000 into 20%. So equals this into 20%, 2,800 is my depreciation. No depreciation or amortization has been yet charged on any non-current asset for the year ended 31st March 2012. Depreciation and amortization are charged to cost of sales. There you go. So you're going to charge to cost of sales. So debit, P&L, credit, property, plant, and accumulated depreciation. Are we clear? Okay, so a prayer break. Okay, students asking for a prayer break. Okay, I'm going to give you a quick 10 minutes prayer break before I do this. So a quick 10 minutes prayer break, 7:15. So until 7:25, 10 minutes prayer break. Be back soon. Okay, bye-bye.
Good. También, கொஞ்சம் கூட்டினேன்.
Okay. Right. You're back, everybody. In March 2012, Fresco's internal audit department discovered a fraud committed by the credit controller who did not return from a foreign business trip. The outcome of the fraud is that 4 million of trade receivables have been stolen by the credit controller and are not recoverable. Of this amount, 1 million relates to the year ended 31st March 2011 and the remainder to the current year. Fresco is not insured against this fraud. Okay, what has happened? Quick, what has happened? What has happened? What has happened? Don't tell me fraud has happened. I know it's a fraud. Number 5. I know it's a fraud. What's the accounting adjustment that needs to be done? What is required to be done? You're going to tell me, okay, Zian, this is how are you going? Non-recoverable debts. Okay, that's right. It's a non-recoverable debt. I'm with you. Fine. So how do we remove it? First, IAS 8 accounting policies changes in estimates and error says if there is any error, brought forward error has to be adjusted in the opening statement of changes in equity. So in the statement of changes in equity, you're going to adjust. Okay. One thing. How much are you going to in the opening retained earnings of statement of changes in equity? How much are you going to adjust? You're going to debit retained earnings of 1,000 because this has to be adjusted in the brought forward retained earnings. You're going to debit admin for the remaining 3,000 because it is in the current year. From trade receivables, you're going to credit trade receivables of how much in total? 4,000. Are we clear? Are we clear? Are we clear? Understood? Working number 5. Fresco's income tax calculation for the year ended 31st March 2012 shows a tax refund of 2.4 million. Okay, now you have a tax refund. Why? Because if you make a profit, you pay taxes. If you don't make a profit, if you make a loss, there's a tax refund, meaning you are going to get a refund which you can use in the future. The balance of the current tax in the trial balance represents the under or over provision of the tax liability for the year ended 31st March 2011, and at 31st March 2012, Fresco had taxable temporary differences of 12 million, requiring a deferred tax liability. The income tax rate is 25%. Okay. If you get a question like this, all what I want you to do is I want you to put up 3 T accounts. Simple as that. So working 6, income taxes. So you're going to put up 3 T account. That's your first T account, copy, paste, second T account, copy, paste, third T account. So income tax account, tax, you call them income tax account, tax payable account, and of course, the last one will be deferred tax account. Simply put up 3 T accounts. Once you put up 3 T accounts, please take the brought forward figures. Okay, go to the question, brought forward figures. What are your brought forward figures? Deferred tax, you have 3,200. Current tax, you have 800. Current tax on your debit side, so I'm going to take my brought forward 800. And then deferred tax, I have on my credit side 3,200. I'm going to take it on my credit side here. Okay, now I'm going to account for the current year taxes. My current year taxes, they say shows a tax refund of 2,400. So that means I am not going to pay taxes. Instead, I get a tax refund. So in this case, I have a tax asset. So normally what I will do, I will debit income taxes, credit tax payable. Now I'm going to reverse it. So now what I'm going to do, I'm going to debit my tax payable account saying income tax. And then I'm going to credit this saying tax payable 2,400. Everybody, you with me? You understood? Everybody, are you with me? Did you understand? And finally, they say Fresco has a taxable temporary difference of 12 million requiring a deferred tax liability. Therefore, you are carried forward. Deferred tax is going to be 12,000 with a deferred tax liability of 25. So equals 3,200 equals 3,200. You have a difference. You're going to take it to your income tax account, which is 200. You debit this, you credit your income tax account. You know that, right? So you say here deferred tax 200. Therefore, you take the total 2,600. 2,600. So to your P&L, you have a credit. You have a credit to your P&L of 1,800. That goes to the P&L, and then finally you have 2,400 here. You have 2,400 here. Carried forward, you have 2,400 tax refund, and brought forward as an asset, we will take 2,400. All our workings are done. We can go back and do the P&L, other company statement of changes in equity, and the balance sheet. Are we clear? Very important. I will look at my notes. Based on my notes, I will do my workings. Based on my workings, I'll prepare my P&L and balance sheet. After that, I will not come here ever again. Okay. Now, statement of profit or loss for the year ended 31st March 2012. What do I start off with? Of course, I have to start off with revenue. I'm going to start off with my revenue. Okay. Always remember, I take my revenue. I look for any adjustments that I did through my workings. Okay. My revenue is standing at 350,000 equals 350,000. Did I make any adjustments? I come down. Any adjustments? Revenue? No adjustments. So I can go right to the top, keep revenue as it is. Next, I've got cost of sales. Cost of sales, I've been given 298,700. There you go. 298,700. What are the adjustments I made? I come below. Adjustments, rights issue, no impact. There you go. Revaluation. I have made depreciation as a result of revaluation. It's going to be 4,500. I'm going to add it. So depreciation, I'm going to add it to cost of sales. And then once again, I've got depreciation here, 5,000. I'm going to add it. Once again, I've got depreciation here, 2,800. I'm going to add it. In total, I've got 311,000. That gives me gross profits. That gives me gross profits of this minus this 39,000. Are we clear? So didn't get how the 3,000 came for deferred tax. Okay, 3,000, how did it come? Your taxable differences, you have 12,000. That requires a deferred tax liability of 25%, 12,000 into 25%. Okay. Gross profit done. Next is my admin. My admin already I've got 26,900. So I'm going to take 26,900. What are the adjustments? I come down. Admin, rights issue, no impact. Depreciation is taken. Admin, what do I have to take? 3,000 must be added, says Amna. There you go. 3,000 is added. Apart from that, I don't have anything. So there you go. 29,900. Well done. Next, distribution cost. Distribution cost. What do I have, guys? What do I have? Distribution 16,100. So I have 16,100. I remember we did not take anything there. Distribution cost. I remember we do not have anything to adjust there. Therefore, I have my operating profits, that is profit before interest and tax. equals 39,000 minus 29,900 minus 16,100. We don't have operating profits. Instead, we've got operating losses. Change it. Next, I've got finance cost. Finance cost. How much is my finance cost? Let's go back. We've got 300 here. And we also did a calculation. Finance cost 2,300. 2,300 plus 300 gives me 2,600 equals minus 2,600. Therefore, my profit before tax will be equals some 9,600. Then I've got my taxes. My taxes we already calculated. I come down. I come down. I come down. I come down. I have 1,800 to the P&L, but I don't deduct it. Remember, this time I add it. Normally I deduct it, but this time I'm going to add it. That's right, Amna. Therefore, my PAT, profit after tax, will be the sum of this. Are we clear, everybody? Are we clear, everybody? Everybody, I want you to respond. Everybody, do you understand? Everybody. Next, Frisco's statement of financial position as at 31st March 2012. Admin and distribution cost should be deducted. Yes, when I took the total, I deducted it. Okay, I deducted it when I took the total, I deducted it. Yes, that's right, Amna. That's why I don't deduct it. Okay. Statement of changes in equity before statement of financial position. Yeah, that's right. So let's put up Frisco's statement of changes in equity as at 31st March 2012. Okay. What do you have? Share capital, share premium, revaluation, and retained earnings. Everybody, give me the brought forward figures. Everybody, give me the brought forward figures. Everybody, I want everybody to start responding. I want everybody to start responding. Give me the brought forward figures. Start off with share capital. How much is your share capital? How much is your share capital? We've got share capital of how much, guys? 45,000. And then share premium. How much do we have share premium? You're going to take your brought forward. Your brought forward is going to be 45,000. Your share premium is going to be 5,000. That's lovely. Your revaluation, you don't have anything, 0. Your retained earnings brought forward, that's right, Amna, very well done, 5,100. Okay, now your share capital will change due to issue of shares. Your revaluation will change due to any revaluation gain or loss. Correct? Your retained earnings will change with profit or losses. If you have any dividends, you will deduct dividends. If you have any adjustments, you do the adjustments. Okay, this is the normal. We have the normal changes in equity statement. Did we issue shares? Yes, I remember we issued shares. Share capital 9,000, share premium 4,500. So 9,000, 4,500 done. Did we revalue? I remember we revalued. Our revaluation gain was 4,000 over here from here. Retained earnings. Yes, we don't have a profit. Instead, we have a loss. I'm going to go to the top, account for the loss. Do you have anything else? Additional depreciation, well done. Additional depreciation, well done. I've got 500. Listen to me. This is how I set off additional depreciation. How do I set off? I remove from retained earnings. Sorry, I remove from retained earnings and I bring it to revaluation. If I'm removing from retained earnings, this time depreciation is an expense, so my expenses would have gone up. So I have to reverse it, meaning my retained earnings will go up and my revaluation will come down. So the net impact on equity is nothing. It's going to be the same thing. That's right. There is a fraud. Thank you very much. There is a fraud adjustments. How much is the fraud that we have? Fraud opening retained earnings 1,000. This has to be adjusted as well. So once again, I come to the top. Fraud equals minus. Therefore, my net impact will be 54,000, 9,500, 3,500, and 3,200 loss. I'm done. I'm done with my statement of changes in equity. So my carried forward, I can set off against my equity section in the balance sheet. I have my statement of financial position. Assets, non-current assets. Under non-current assets, what do I have? Property, plant, and equipment. Correct? I have my property, plant, and equipment. No, I have to add it, right? It's 3,200. I have to add it, right? Amna, my retained earnings is already understated. So now I need to increase it. And I increase my retained earnings. I set off against my revaluation. You got it? You got it? Yes, it's included, right? I just included it, right? Okay, super. Now, my property. How much is my property? Everybody, how much is my property? Value of my property? Okay, so I've got an adjustment. I've got a response directly saying is 62,700 after adjustments. Okay, Amna, explain us. Okay, Amna, how did you get this 62,700? I want to know. Amna, how did we get this 62,700? This is plant is 31,500, lease 20,000 plant, and equipment 11,200. Let's go and check. Okay. Now we have leased property. Now, if you have leased property, let's go down. Our net book value of leased property is going to be 20,000, which we already got it. That's right. And then we've got plant and equipment. So plant and equipment, we have to check how much it is. Okay, how did you get this 31,500 now? So there you go. 14,000 minus 2,800 for plant and equipment. So you've got 11,200, correct? 14,000 minus 2,800, you've got 11,200, that's correct. And then you have a 31,500. Okay, how did you get your 31,500? 36,000 minus 4,500. Okay, so there you go. So equals, hold on, leased property. So we have a leased property and a leased. Give me a moment. Okay. So we have property, plant, and equipment, all three put together. So leased property, leased plant, and equipment, correct? Now, when you look at your leased property is going to be 36,000 minus depreciation 4,500, 31,500. Your lease plant is going to be net book value, which we calculated already over here, which is 20,000. Your equipment is going to be we just calculated somewhere down, 11,200, correct? Therefore, my total property, plant, and equipment value is going to be 62,700. Got it, everybody? That's correct. Lovely. Current assets. What do I have? Current assets. Inventory. My inventory is standing at 25,200. I did not make any adjustments. We know that. And then my trade receivables. My trade receivables will be equals 28,500. Did we do any adjustments? Remember, we had a fraud, 4,000 minus 4,000. That is the reserve counter. And then what else do I have? Cash, no bank overdraft. But remember, we had a tax refund. There you go, Amna. Well done. There is a tax refund. And your tax refund is going to be 2,400. Therefore, my total is going to be 52,100. Therefore, total assets equals this plus this 114,800. Okay. When I come to equity, my life is very simple. Share capital, share premium, retained earnings, and then I've got my revaluation. Well, I've already done the calculation, so I don't have to worry too much. My share capital, I'm going to slap it from here, 54,000. My share premium, 9,500. My retained earnings is a loss of 3,200. And then my revaluation reserve is 3,500. There you go. Therefore, my total equity will be 63,800. Moving on to my last bit. Guys, are we clear so far? Moving on to my last bit. I'm going to do my current liabilities. Under current liabilities, I will start off with trade payables. How much is my trade payables? 27,300. We did not make any adjustments. In the back of your mind, you know that. And then we had lease. So don't forget, we have lease payables. So how much is our lease payables? Current liabilities, we apportioned it. Remember, we come down. 4,070. Anything else? Anything else? Okay. Yeah, 4,070. That's right. Bank overdraft. Well done. Bank overdraft is going to be 1,400. There you go. So total current liabilities is standing at 32,770. Finally, non-current liabilities. Non-current liabilities. What do you have? Once again, don't forget, if you have lease payable for current liabilities, you're going to have it for non-current liabilities as well. How much is that? 15,230. And then what else? What else? What else? What else? What else do we have? Guys, everybody, what else do we have? Amna says deferred tax. Deferred tax. She says it's deferred tax. Deferred tax. How much is your deferred tax? Carried forward 3,000. Very confident. There you go. Lovely. Therefore, your total non-current liabilities will be this. Therefore, total equity and liabilities equals this plus this plus this. Hopefully it balances 114,800. 8 balances. It balances. Let me show you the question. Sorry, the answers. There you go. Can you send this in group after class? I have been sharing this on a daily basis with you. So we've been asking this on a daily basis. I've been sending this on a daily basis, but that's okay. I'm going to send it to you again now. Okay. There you go. Guys, quick question. Everybody, did you understand what we just did? Yes or no? Quick question. Did you understand what we just did? Yes or no? Quick question, guys. Did you understand what we did? Quickly tell me, did you understand what we did, guys? Yes or no? Okay. So we've been continuously meeting, and today also we've met. One last question. Do you want to continue this tomorrow as well? Do you want to continue this tomorrow as well? Yes, give me an A. No, 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 I'm fine, Zian. Give me a B. Okay, so let's keep the hype together. We'll continue this tomorrow as well. Tomorrow, once again, at 6:30, we meet up. Okay? Tomorrow again, we meet up again to do more questions. Until then, I want you to start practicing questions. I want you to go back practicing more questions and referring back to the questions that I'm doing as well. So I'll catch up with you all tomorrow. Until then, take care. Bye-bye. Have fun. Do you have morning class tomorrow? Let me confirm in the group. Okay, let me confirm in the group. I'll confirm now.